Thinking about investing but don't know where to start? Heard about SIPs but confused about what they are and if they're really worth it? Today we are breaking down SIPs, what they are, what are the benefits, what are the drawbacks, and everything in between. So, first things first, what exactly is an SIP? SIP or systematic savings plan is a way of investing regularly in mutual funds. It's like setting up a savings plan where a fixed amount is deducted from your bank account and invested in a mutual fund on a recurring basis, monthly, weekly, quarterly, whichever works best for you. Now, the question is, why should I invest in SIP? We have multiple options these days. And what makes it different from just saving money in your bank? The purpose of an SIP is to help build wealth over time without needing to be a financial expert. By investing regularly, you're harnessing the power of rupee cost averaging and compounding, which allows your money to grow and beat inflation. If your money is sitting in a bank account earning 4% interest, you're actually losing money. But with an SIP, since it's linked to high growth assets like equities, you have a chance of earning higher returns that can potentially outpace inflation. SIPs are especially helpful for young investors or those new to investing. You don't need a big sum to start, and by investing a fixed amount each month, you are actually avoiding the risk of entering at the wrong time in the market. And if you're increasing your investments at 10% annually, eventually you'll begin to feel the power of compounding. Now, before I break down some of the biggest reasons why SIP is so popular, let me clear out one common question, which is what's the difference between SIP and mutual funds? To understand this, think of mutual funds as a big basket of investments. You can invest in this basket either all at once, which is called lump sum investment, or in regular intervals, which is where SIP comes in. An SIP is simply a method of investing in mutual funds or even direct stocks. Let's say you have rupees 60,000 to invest in a mutual fund. With a lump sum, you actually put all 60,000 in at once. With an SIP, you might invest 5,000 each month for 12 months. SIPs make it easier to invest gradually, spreading out your investments. Hence, SIPs are best for those who want to invest but do not have a large amount to start with. So, coming back to why SIPs are so popular. First, SIPs make investing disciplined. Since the amount is deducted automatically from your bank account each month, you're building a habit of saving and investing without even thinking about it. Next, rupee cost averaging. This sounds complex, but it's simple. By investing at regular intervals, you're buying more units when the market is down and fewer when it is high. This helps in averaging the cost per unit over time and reduces risk associated with market volatility. And then, of course, there's the magic of compounding. SIPs allow you to reinvest your returns, so over time, you're not just earning your initial investment but on your returns too. This earnings on earnings effect accelerates your wealth growth. Another great thing about SIP is that they are affordable and flexible. Now, you can start with as little as 100 rupees and increase or decrease your investment over time. Plus, you can pause or start your SIPs whenever you want. However, it's not always green meadows for SIPs, it has its downsides too. Here's what to watch out. First, SIPs are market dependent. Since SIPs are typically invested in mutual funds, which in turn are invested in stocks or other assets, they are impacted by market movements. If the stock market is down, your investment could also see a dip in value. Another drawback, there is no guarantee on returns. SIPs don't come with fixed returns like fixed deposits or bonds. If the market doesn't perform well over your investment period, there's a risk of earning lower returns than expected. Lastly, SIPs work best long term. While SIPs are flexible, they are most beneficial when held for 5 years or more. If you are looking for quick gains, SIPs might not be the ideal choice for you. On the other hand, if you take out your investment within 1 year, you will be charged a short-term capital gains of 20%. Additionally, most mutual funds will also charge you a high exit load on sale within a year. Talking about patience, there are some golden rules you must keep in mind before investing in SIPs. It's usually known as the 7531 rule. The 7531 rules highlights how SIPs reward patience. Investment in mutual funds grow best with time because of compounding. The longer you invest, the bigger your returns. If you say invested for 7 years, you could actually earn annual returns of over 15%. Shorten that holding period and your return starts to diminish and go below 6% if you hold for a year or so. Now, Don't compare that to the bull market cycle we just witnessed. Here I am talking about historical trends and average returns. Then you must diversify your portfolio across 5 asset classes to balance risk and reward effectively. These asset classes include high quality stocks, value stocks, growth at reasonable price stocks, mid cap and small cap, and global stocks. Next time, whenever you feel like pulling some money out of SIPs, the 3 phases come to test. First is the disappointment phase. It is when you notice that you have been investing in SIPs but you're just getting 7 to 10% return. Then is the second phase, which is nothing but the irritation phase, where you see 0 to 7% return on your amounts invested. And the most fearsome and challenging phase of your SIP journey is the panic phase, in which you actually start seeing negative returns. But you don't need to worry. Such returns are rare, and if they happen, are a result of market fluctuations. It will stabilize and give you better returns in no time. When all these happen, all you have to do is zoom out and see that the market always goes up while there will be regular corrections along this path. And finally, increase the amount of your SIP annually. This is similar to enhancing the capacity of your equity portfolio. By doing so, you are making a greater effort to achieve better results. Because if your income needs an annual hike, so does your investments. The result, ability to achieve your goal faster. Let's break this down with an example. Suppose you invest 50,000 per month in an SIP with an assumed annual return of 15%. In 7 years, your corpus will grow to approximately 1.08 crores. But if you increase your SIP amount by 10% annually, your corpus will be around 1.25 crores. That's an additional 17 lakhs by just scaling your contributions. Now imagine the long-term effort. Over 20 years, with a flat 50,000 rupees SIP, your portfolio will be approximately 7.65 crores. However, by increasing your SIP by 10% annually, it could soar to 11.25 crores. That's nearly 3.6 crores extra by just adjusting your income growth. So by giving your investments an yearly boost, you're not just keeping up with inflation, you're actually accelerating your journey towards financial freedom. Investing SIP is one of the best options if it matches your financial goals. If you are someone who wants to invest your money in a disciplined way and have patience until you reach your financial goals, say you're 27, you just started your investment journey and wish to achieve financial freedom in next 10 to 15 years, then you must do an SIP. But if you're kind of person who looks for short-term gains and crave for fast results, then you can explore other investment options. So, what do you think? Are you ready to start an SIP? Drop your thoughts in the comments, and also if you found this video helpful. That's it from me. I'm Nikhil Varghese. Share this video and subscribe to learn how to make your finances less tricky with FinNiki.